I was going to say we can start with silver because that's where the financial system very well could end, is with silver. There's obviously huge tightness all over the world in silver. India has doubled the amount of ounces. Forget about dollars or rupees. They've doubled the amount of ounces they're importing. The bullion dealers in China have basically closed down and they're not selling silver. The one bullion dealer that is selling silver is selling it at $128 an ounce. Silver's gone into backwardation where the futures or where cash is higher than the futures. The lease rates have exploded. It's primed and set up for failure to deliver. And I can't stress enough how important it is for silver not to fail to deliver, because if it does, it'll immediately spill over to gold. And you get action in gold like we're seeing in silver, that's the end of the system. And I say the end of the system because confidence will entirely break. And the fractional reserve / fiat system runs 100% on confidence. And if you break confidence, it goes back to what my late partner Jim Sinclair used to say: what is the value of a contract that cannot perform? And the answer is zero. And he posited that you could see gold futures at $10 offered, no bids, and $50,000 bid and no offer, meaning people will not accept contracts because they know they're not going to perform. They want the real deal in their hand, than they did 40, 50 years ago. And we should talk a little bit about the two spikes in silver that we had previously to $50. 1980 with the Hunt brothers, and then 2011. The Hunt brothers, that was if you want to say that was vapor at the end. I mean, there was a huge spike. It was basically an intraday spike, or within a week's period of time. They did not stay at $50 for any real length of time. And then again, the same thing happened in 2011. We had the spike up. It didn't go through 50. It fell back, and then they smashed it. And of course, they smashed it in 1988 also. This time, I know it's not good to say this time it's different, but it is different. It's already different. You can see it. We've been over $50 now for a week, maybe a week and a half. But the thing is, we've gone through 50, and the buying, if anything, has increased. And the risk here is that the chart goes parabolic, and the blood in the water that the sharks smell is that there's not enough supply, and that that they can break these markets. And when I say break the markets, you've got too many longs demanding delivery, and there's not enough supply. And we're going to find out that both gold and silver have been fractional reserve markets where they counted on only 1 or 2 or 3% of the longs standing for delivery. It's been a process. This has been taking place for 2 or 3 years now. If you look at both gold and silver on COMEX, the first notice day, and I'll just use a number of 100. Let's say there was 100 contracts standing for delivery. Prior to a couple of years ago, 3 years ago, what would happen is you have 100 contracts going into first notice day. And by the end of the month, it might be only half or 25%. In other words, the longs liquidated, took cash settlement, and walked away. But what's happening now is you get first notice day with that same 100 contracts, and by the end of the month, you might have 150, 200, 250 contracts standing for delivery. So no longer can you count on first notice day being a big number, and that's going to shrink from there. What's happening is buyers are set up, they're buying that month contract and saying, I want delivery. So they're piling up now. They're forming a line, if you will.
Wow.
It's a bank run into gold and silver, and that's what's going on with COMEX. But they canceled all those orders. I mean, I think there's still lawsuits going on about that. But basically, what they did was they pulled the plug on that market, and they said all the days trading didn't count. They weren't traded, and the way they did that was they didn't have to pull their pants down and say, look, we can't deliver this. Well, first off, that will bleed over to gold, and gold will also fail to deliver. Understand that gold and silver have been suppressed. The prices have been suppressed literally for 50 years, since 1976 when they started with futures and options on metals. Understand that gold has been suppressed because it is the direct competitor to fiat currencies, whether it's the dollar, the pound, the euro, the yen, whatever fiat currency, gold is the direct competitor. Now, if, let's say, 10 years ago, gold didn't stop, or 15 years ago, gold didn't stop at the $1,900, $2,000 level, and it blew through, and it got to $4,000 like we are now, and Then it moved to 6, 7, 8,000 and started spiking. What that tells you is it's not gold going up, it's the fiat currency that's losing value. So that spills out and it becomes a loss of confidence, and that would have and will prevent the U.S. from using a credit card with. Hold on. It would prevent or preclude the U.S. Treasury and other treasuries that borrow, but the U.S. in particular that has had an unlimited amount to borrow on the credit card. And thus, we've got $37, $38 trillion. It would cause interest rates to go up. It would just gum up the entire system, which would then gum up the real economy. But it would be extremely difficult for finance to continue as finance has continued, because it's been a Ponzi scheme, of credit, and it would cast a dark shadow on credit. Meaning, am I going to get paid back? People will be wondering about the credit system. And that's a problem. And you and I have talked about this before. Everything runs on credit. The entire financial system runs on credit. The real economy, everything that you touch, everything that you do every day has, credit has touched it in one way or another for that to have been created or be able to work.
Let's start with silver, because that's where the financial system, as we know it, could very well meet its end. This isn't an exaggeration. It's arithmetic and physics colliding with decades of financial deceit. The signs are flashing red everywhere. In India, silver imports haven't just risen in value. They've doubled in ounces. Think about that for a moment. India, one of the largest silver consumers on Earth, isn't counting the cost in rupees anymore. They're counting it in ounces. Meanwhile, in China, bullion dealers have practically shut down silver sales altogether. The few that are still open are quoting spot prices of $120 to $130 per ounce. That's nearly triple the Western paper price. What does that tell you? It tells you we're witnessing two parallel universes, one made of digits and paper promises, the other of metal and reality. In the paper world, silver is worth $50. In the real world, you can't get your hands on it for less than twice that. That's not just a price discrepancy. That's a system screaming that it's about to break. Silver is now in backwardation, which means the spot price, the price for immediate delivery, is higher than futures prices. That's not supposed to happen in a healthy market. It's a sign of desperation. Buyers are saying, I'll pay more to get it now because I don't believe you can deliver it later. And they're right to be skeptical. The lease rates for silver have exploded. They're not at 2% or even 10% anymore. We're talking double-digit, panic-level lease rates, the kind you only see when no one wants to part with metal, not even for a short-term loan. It's the market's way of shouting that the cupboard is bare. And this isn't just about silver's supply-demand mechanics. This is systemic. If silver fails to deliver on COMEX, and make no mistake, we're teetering on that edge, it will immediately spill over into gold. If silver breaks, gold follows. And if gold follows, the entire fractional reserve fiat system collapses because confidence is gone. And that's the linchpin here. Confidence. The modern financial system isn't built on value, it's built on belief. A fiat system runs entirely on confidence. Confidence that banks will open tomorrow. Confidence that your deposits exist. Confidence that your digital balances can buy real goods. The minute that confidence cracks, the game's over. My late partner, Jim Sinclair, used to put it perfectly. What is the value of a contract that cannot perform? The answer is zero. That's what happens when a system built on paper promises runs out of the real thing. At that point, you don't have a market, you have chaos. Jim used to imagine a day when gold futures could quote, $10 offered, no bids, meaning nobody wants the contracts, while simultaneously trading $50,000 bid, no offers for physical gold. In other words, nobody wants paper gold, but everyone wants the real deal at any price. And the truth is, that day might not be far off. If you study history, you'll notice silver always tells the truth before gold does. The 1980 spike, when the Hunt brothers tried to corner the silver market, was short-lived, a kind of warning shot. Silver briefly hit $50, but it didn't hold. The system panicked, regulators changed the rules mid-game, and the price crashed. In 2011, we got another shot to $50. Again, it didn't last. The bank smashed it back down. But this time it's different. And I know when it's dangerous to say, this time it's different. But look around. Silver has broken through $50 again. But unlike those earlier spikes, it's staying there. Not for hours or days, for weeks. And instead of cooling off, the buying pressure is intensifying. India's importing more. China's hoarding. Western mints are out of stock. Refiners are booked for months. The sharks can smell blood in the water. They know there isn't enough supply to meet the tidal wave of physical demand. What happens when too many longs demand delivery in a fractional reserve market? The system breaks. That's what's happening on COMEX right now. For decades, they've counted on only 1 or 2% of contract holders actually standing for delivery. That's how they've managed to run a paper-to-physical ratio of 100 to 1 or more. But now that assumption is failing.
So it's important to understand that silver being such a small market, it's been very easy to manipulate. And they had to manipulate silver harder than gold because if silver ever got on hand, then gold goes. And if gold goes, then you have confidence breaking. And understand that you were talking about derivatives. It's a zero-sum game in the OTC derivatives market where there's over $2 quadrillion worth of paper or contract. The problem with that, because it's a zero-sum game, if you have a huge winner, that also means there's a huge loser. And was that loss big enough to put the loser out of business? And if the answer is yes, then the loser can't pay the winner, which means the winner then becomes a loser also.
Right.
And that will spread across markets everywhere. That'll spread across credit markets. It'll spread across stock markets, equity markets. Interest rates will explode. That'll destroy the ability to carry real estate on debt. It's a seizure or a meltdown of credit is what we're facing. Yeah, there's always a chance because you used the word for a while. For the end scenario, mathematically, no, they cannot fix this. They can't kick the can down the road. It's here. It's now. They're using their old tricks. They've raised margin on COMEX, which they've done many times before. They raised the margins and then forced the longs out because they can't afford the margin. They sell. I think the other day, in an hour's time, they sold something like 20,000 contracts. I mean, that's a huge amount of silver, and that silver does not exist. Remember, it's 5,000 ounces per contract, which I think that number worked out to be about 1 billion ounces were sold. The world only produces 850 million ounces collectively in a year's time.
Yeah.
And that's only $40 billion.
Yep.
The global production of silver, even at all-time high numbers of $52, $53, is only just over $40 billion. I think that's not really the right way to look at it. It shouldn't be concerning. If you're sitting on silver and markets close, I can't think of another asset that I want to have in my hands other than a loaded gun and food. I cannot think of any monetary asset that I would want in my hands other than silver if markets close. And I'm not dissing gold. Gold is for, that's your store of wealth, but you're not going to trade in gold. I mean, you're going to have a hard time with silver eagles or 1 ounce bars or 1 ounce rounds, silver rounds. You're going to have a problem getting change back. I mean, if you deal with a farmer and let's say you want 2 dozen eggs, how are you can't get change back, but a silver dime will do it.
So why do
you want to talk about that?
Go ahead.
Let me just mention this because I've got a bunch of emails in the last 3 or 4 days. The wholesalers have really pulled their bids back on junk silver. Junk silver now, if you're going to sell it, you're looking at $2.50 or $3 below spot. The only silver above spot in North America are silver eagles. I think they're about like $1 over spot. But people are concerned that, oh my gosh, I'm not going to be able to sell my silver. Well, understand that when all this silver that's been sold, all this junk silver, that's been melted down. And of course, they've not made any silver dimes or quarters since 1964.
Now let's take that thought forward, because when this finally happens, when silver fails to deliver, you're not just looking at a market event, you're looking at a full-blown systemic failure. This isn't about the price of a shiny metal. It's about the destruction of confidence in the entire fiat pyramid. Once silver goes, gold follows. And when gold follows, the dollar's credibility evaporates. See, the thing people forget is that gold and silver are like the report cards for fiat currencies. When they go up, it's not because they suddenly became more valuable. It's because the paper measuring them is losing value. Gold and silver rising are just the mirror image of fiat money falling. And once the world realizes the dollar isn't the safe asset it pretends to be, you'll see an exodus unlike anything in financial history. Let's put this into perspective. The entire Western financial system runs on a foundation of credit and trust, trillions of dollars in transactions every day, and not 1 ounce of it is actually settled in anything real. It's all electronic entries, claims on claims, promises on promises. As long as people believe those promises will be honored, the illusion works. But once a key promise fails, once someone says, "I want my medal," and the system can't deliver, that belief collapses like a house of cards. And remember, COMEX and the LBMA are not stock exchanges. They are delivery mechanisms for physical goods. The entire credibility of those markets depends on one thing: delivery. If you can't deliver, your market doesn't exist. That's why I keep saying, failure to deliver in silver is a nuclear event. It's the domino that takes down the rest. We've already seen the warning tremors. Lease rates through the roof, futures markets in backwardation, physical premiums in Asia exploding to double or triple the paper price, refiners in the US and Europe running 24/7 and still weeks behind schedule, and most telling of all, central banks quietly hoarding gold while the West tries to convince you everything's fine. I'll tell you what's really going on. This is a slow-motion bank run on the entire system. Wealth is quietly exiting paper assets and moving into tangible ones. And silver, because of its small size, will be the trigger that makes the shift go vertical. Now, some of you remember what happened in 1980 with the Hunt brothers. The mainstream always tells that story as, the Hunt brothers tried to corner silver and got burned. But that's only half the truth. What really happened was that the Hunts exposed the vulnerability of the system. Their buying forced silver's paper shorts to panic. And when the exchanges realized they couldn't meet delivery, they changed the rules mid-game, raising margins, restricting buy orders, and eventually declaring trades invalid. They didn't save the market, they saved the banks. Then it happened again in 2011. Silver raced toward $50, the same red line as in 1980, and just when momentum was building, the margin hikes came again. 5 hikes in 9 days. That wasn't the market deciding silver was overvalued. That was the system fighting for survival. The pattern is always the same. Whenever silver threatens to break free, they crush it with paper. But here's the key difference this time. The East is calling their bluff. In 1980, the Hunts were 2 brothers. In 2025, it's nations. India, China, Turkey. These are billion-person economies demanding physical metal. They're not going to settle for cash. They don't want IOUs. They want real bullion, and they're willing to pay whatever it takes to get it. China's domestic dealers are already posting prices over $120 an ounce. India's silver imports are up 100% year-on-year, measured in ounces, not currency. And in both markets, the word on the ground is simple: there is no supply. Western vaults are draining eastward. Every bar that leaves London or New York for Shanghai is 1 less ounce that can be rehypothecated 100 times over. So let's imagine the moment this breaks. COMEX hits delivery month, and a few thousand contracts stand for delivery. That's nothing new. But this time, instead of 2% of longs taking delivery, it's 20%. The vaults can't deliver. The shorts scramble to cover, but there's no metal left. The exchange declares force majeure, cash settlements only. They offer to pay out spot price in dollars. But the physical market is already trading at twice that in Shanghai. The spread explodes, and everyone watching realizes the paper market price is a lie. That's the spark. The fire spreads instantly. Gold traders panic, fearing the same will happen there. Delivery demands skyrocket. Central banks stop leasing out gold. The paper market, built on the assumption of endless rollover, seizes up. Suddenly, every ounce of unallocated gold has 10, 20, 50 claims against it, and the world realizes the cupboard is bare. What happens next? A total loss of confidence. The same derivative contagion we've talked about hits every other market. Because remember, the financial system is one giant web of interconnected bets. When one side of the bet goes bust, the losses cascade. Let's say a major bullion bank gets caught short on delivery. Maybe JP Morgan, maybe HSBC. They can't meet obligations. Their counterparties panic, trying to unwind exposure. That panic spills into currency swaps, repo markets, treasury trades. Liquidity vanishes. Interest rates explode. The cost of borrowing doubles, triples. Suddenly, everything that depended on cheap debt, real estate, corporate buybacks, government deficits starts to implode. We saw a preview of this in the UK pension crisis of 2022, when a tiny spike in bond yields almost took down the entire system. The Bank of England had to print billions overnight to keep funds solvent. Now imagine that, but global. The Fed, the ECB, the BOJ, all forced to print simultaneously to bail out the unbailable. But here's the kicker. Printing won't work this time, because printing only works when there's still confidence in the currency. In 2008, they could paper over the cracks because people still believed in the dollar. In 2025, after 2 decades of QE, zero rates, and government debt explosions, that trust is gone. Every dollar they print will make people run faster into real assets. That's how you get hyperinflation, not from prices going up, but from faith going down. And the metals will reflect that in real time. Silver won't just rise, it'll disconnect. You'll see physical silver at $150, $200, $300 an ounce, while COMEX quotes $60. That's not speculation, that's repricing reality. Gold will follow, moving not in hundreds, but in thousands. 10,000, 20,000, who knows? Because at that point, you're not measuring gold in dollars. You're measuring dollars in gold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.